Guys, Jeff here, back again with another video. I know that it's been quite some time since I uploaded my last video. Work has been very busy, and also my computer broke down, so that didn't really help with the progress of the video making. However, I have never stopped uploading my daily news on my Instagram, so if you have not followed me there, link is down in the description box down below. That's where I put my Instagram handle. Just follow me there. I will upload news about the market every single trading day. Alright, so today I'll be talking about tapering. This is something that I've always been talking about in my daily news as well, especially with the entire tapering, inflation, Jerome Powell, everything of that nature. Tapering is one of the core things that I actually talk about. So there are also a lot of people who do not know what tapering is even until today, but it's okay. I'll be putting up the Investopedia description up here. So tapering refers to policies that modify traditional central bank activities. Tapering efforts are primarily aimed at interest rates and at controlling investor perception of the future direction of interest rates. Tapering efforts may include changing the discount rate or reserve requirements. Tapering may also involve the slowing of asset purchases, which theoretically leads to reversal of quantitative easing, QE, policies implemented by a central bank. Tapering is instituted after QE policies have accomplished the desired effect of stimulating and stabilizing the economy. So if you're too lazy to read all that, or just focus on me repeating it verbatim from the Investopedia website, it simply just means that it's buying lesser of or in a slower rate of purchasing into something. So in financial sense, usually we are talking about a tapering of bond purchases, which is buying lesser bond purchases every single year. So before we actually get into tapering, let's talk about bond purchases first. Alright, so during an auction for a bond purchase, the treasury will say, alright, guys, I have 10 pieces. Okay, I'm just gonna take my notebook as, alright, I got 10 pieces of this 10-year treasury bond. So let's just imagine that this is gonna be split into 10 pieces. And then let's just say the buy-in for this treasury bond is currently at $100. So every single year you hold on to this, you get $1, which essentially gives you 1% interest. And you get to cash out this $1 every single year, which then, at that set auction, no one wants to buy this 1% good for nothing bond. So the treasury will maybe then take the price down a little bit and say, okay, you know what, how about this? We can lower this bond pricing down to $80. And then at the same time, if you are buying this whole thing for $80 and you're still getting $1 every single year, the same 1% for the initial $100 buy-in is now costing you $80, which then gives you $1 for 1.25%. And yeah, maybe it's still not as enticing as all the other things that we have seen. So the treasury might just go, okay, you know what, since no one wants to buy this at $80, how about I just lower it to, say, $60? So right now at $60, if you're buying this at $60, it was an initial buy-in of $100, but every single piece still gives you $1, which means that essentially you are buying in at a 1.66% yield rate, which isn't too bad. In fact, that's actually quite a good rate for bond purchases. So right now, people will be like, all right, I want to get some of these bonds now because I think 1.6% is a lot better than what I can get if I just want to do some normal bank deposits with the bank where I get about 1% or so. So because of that, then the bond yield would eventually go back down because the demand for the bond is currently going to slowly go up because a lot of people want this for $60. And because I only have 10 pieces of this, someone will eventually say, all right, I'll pay $61 for it.
$100,001.
And then somebody will say, all right, I'll pay $62.
$200,000.
Fine, we have $2.
And then that's how an auction works. And eventually, because of this initial $100 buy-in would eventually get bumped up to about, let's say, $70.
$2 million.
Where that's the last person is like, all right, you know what, I'm going to buy for $70, and no one wants to go to 71, and which is why $70 would be the last purchase to the last guy. And then right there, you are going to be looking at maybe 1.5% interest bond yield for the entire bond purchase. So yeah, essentially what this means is that, if the demand is high for the bond purchase itself, which means that we are able to actually tweak the supply and bottleneck the supply itself just so that we can fit the demand. And that's how the Federal Reserve are actually printing money. They don't just go and operate that money printing machine immediately. What they do is that they create all these sort of bonds and then they sell it out. And then the Feds will then have to buy back those bonds, which then essentially just create money into the system. So something that I actually look at every single day, something that I also try to post on my Instagram telling you guys as well, which is the 10-year Treasury yield graph. This is something I look at almost every single day. And this is the reason why. So inside this graph, you can see that there is a lot of up and down. This is kind of how like a stock market operates as well. So what happens if nobody actually buy the bond? And that can actually happen. In fact, it actually happens every single day because the Feds are just buying into the bond. And of course, there are also the top companies such as Apple. They're also heavily buying the bonds. Even I don't believe Tesla is doing so. However, I know that like Microsoft, Apple, all of them, the bigger companies out there, they have to put their money somewhere, and I don't think it's smart for them to just put it in cash alone, and they cannot put it into risky investments. So ultimately, they'll just put it back into bond purchases, which is why they actually just report in their filing where they just show cash and securities, and most of the time it's just bonds. Alright, so now that you have a basic understanding of what bonds are, let's get back to tapering. Alright, so like what I said before, tapering is like buying less of or a slower rate of buying into. So the Federal Reserve are talking about tapering, which means they are going to be buying lesser of these bonds, which means that if they are going to buy lesser bonds every single year, essentially what they are creating is lesser demand, hence creating more of a supply gap, which then the yield will continue to go higher. So what's the issue there? You have higher bond yield for your bonds. What's the issue here? Alright, so now then we have to talk about the stocks market. So the stocks market that you and I invest in, typically we're looking at, let's say, a good 4% ROI on a bad year, or when the market is booming, let's say about a 10%. I do want to just put this in as a disclaimer because the thing is that for the amount of growth that we have been seeing in 2020 and 2021, it is very, very irregular, and that is not supposed to be the case. If you actually look at it in a historical manner, getting about a 7% year over year is a crazy good year. And of course, you know, if we are looking at 2020 and 2021, personally, I've already made about 120% ROI on my 2021 alone. So I don't think that's a very fair amount of data for us to actually do this entire thing. So I just want to say, we just use the historical matrix for it, which is 4% on a bad year, about 8 to 10% on a very, very good year, or on the S&P or the Dow Jones or the Nasdaq, whatever it is, on an index fund. Alright, so for example, if you are going to buy into Dow Jones or you're going to buy into Nasdaq and you're expecting 4% on a good year, okay, maybe not say a good year, maybe just say a mediocre year. Right now, if I'm going to tell you that right now, if I were to offer you this bond purchase, you're able to get 4% yield with zero risk. Okay, essentially zero risk. I just need to put a disclaimer out here. It's just essentially zero risk. It's not exactly zero risk, but yeah, bonds. I know. But yeah, to any passive investors, which I think it actually constitute a huge part of the market for passive investors, this is music to their ears. That means that they will jump on the chance the moment they can see all these cheap bonds hitting the market, because high yield is what they provide and high yield is what I want. And remember now that if the tapering is happening, yield will go up. And since demand is low, which is kind of bottlenecked by the fact that the Feds are buying lesser off every single year, the supply will have to correspond to the demand, and the yield will then, of course, increase. So if you think that 4% is impossible, we had 5% back in 2006. It is possible. Okay, I'm going to put up the chart. You can see right here it's about 5%. And so anyway, I feel that, passive investors who invest in the S&P or the Nasdaq or the Dow Jones will probably be like, I can probably get about 1 or 2% more if I actually get into S&P or the Dow Jones or the Nasdaq or any of the other index stocks or ETFs. But if I actually do that, there is still some sort of risk, and market correction might happen anytime. There might be a sudden sell-off. There might be bad earnings for one of the top 3 companies or the top 10 companies. So, if anything, I can use 1% for me to negate the possibility of me having to take on any of those risks. I think that's not bad. So what do you think will happen the moment they think that, alright, I think bonds are better than the index funds. So in my opinion, I think that they will definitely jump on the chance of to buy those bonds without question, actually. But now, then this creates another question, which is where do they actually get the money to buy all these bonds? Because all these bonds, you require initial capital as well. So remember when you see various news on your CNBC, your Wall Street Journal, your Fox News, whatever it is, you see S&P hits new highs, S&P new highs, Dow Jones new highs, everything is on a new high. And this has been going on for the last 7 months. We are on a 7-month bull run, which is why you would know that all the investment in the S&P are all money.
Money!
So all of that, well, I would assume a good portion of that, if they do not fully liquidate their entire position, will get sold off and put into bonds, which is very normal because I feel that, you know, the bond market and the stocks market is actually quite a balance where a lot of money just goes all around and then they just kind of stimulate both sides of the economy and kind of make the whole world go round. So I don't think I need to be the one to tell you guys that, you know, during a huge sell-off in the market, prices will eventually go down. And of course, if you see the S&P, when you see the bond yield going up, it is a very normal trend for us to see, especially for myself. I look at the charts every single day, even on weekends, just to study a little bit more for the charts itself. You can see every single time the bond yield spike up, the S&P goes down, because this is what people are thinking of. I want to get a little bit more of the good side of the bonds, and I want to negate a little bit of risk over on the S&P. It is a very normal thinking process. So yeah, so now that this happens and the S&P just say sell off so much during this whole high yield bond appearing in the market, selling pressure then creates more selling pressure. And of course, with such a huge selling pressure, all in all, this will definitely make all the investors, such as myself, buy the dip.
Here we go. Come on, push it. Find the dip. Find the dip.
But even so, we are also looking at one heck of a sell-off. Those people who are buying the dips might be catching falling knives, and that might not be the best thing. Which is why that even if we were to buy the dip, so we might be able to support this entire dip, but the thing is that what I'm afraid of is that we might create a support line that we cannot support, and then it will just keep on going down, and then more people will have this sort of fear, uncertainty, and doubt around it, the FUD around it, and then they will just be like, okay, you know what, I'm going to get out, even at a loss, I'm going to get out and get back into bonds, which is why this kind of creates this kind of negative spiraling down effect. So all this will actually affect a lot of things. So your tech stocks, your growth companies, your innovation, fintech, futures, all these companies, they are all going to get booted during the first mention of a taper, because all these companies are so-called high PE value companies. And with high PE value companies, they don't have anything to show for it other than the fact that people are betting on the fact that their profits over earning is going to be way higher in the future. And that is why people are putting their money, investing in the future of their company. But the thing is that if we do not have a proof of stake or a proof of work of what they can actually do, and in the short term, it is a better bet for us to take out our money first and then put it into something safer. And when they actually show that they can handle a situation, a pandemic, a taper tantrum, anything of that nature, and then people will then, okay, you know what, I'm gonna put more money back into the growth companies, the tech companies, the fintech, things of that nature. And this is kind of why that, you know, when the market hear the word tapering, they just freeze up. You know, the thing is that back in 2013, when they heard the word taper, about a year after they had a taper tantrum, which is why even now when the Federal Reserve wants to even utter the word taper, they have to have the talk about talking about wanting to possibly taper in the next few years. And, you know, there's a lot of tiptoeing around this entire situation, and I feel that, you know, the market is like a child and the Federal Reserve is the parents, and they just do not know how to give the child some bad news, and they try to preempt them for the bad news years in advance, and sometimes even then it's not enough. So that is kind of why that I'm thinking, you know, tapering is quite scary for myself as well, because I do have a lot of stocks in those affected industries, and if you do want to know what I'm invested in, I'll leave an annotation up here somewhere revealing my 6-digit stocks portfolio. However, the thing is that during the Jackson Hole Symposium speech, Jerome Powell actually came out to talk about the whole tapering process, and there's something that I actually did not take into consideration, which is that how Jerome Powell actually spoke about it is that if we were to taper during a bad month, which is where our CPI or our PCE data are actually very, very high, and we start to taper immediately, the thing is that the tapering might actually only take into effect few months down the road, and it's not going to immediately apply to it, which is why it's very important for us to taper sooner than we expect the inflation to hit as hard as it could. This is something I did not really think about as well, because when Jerome Powell explained it, something actually clicked, and I kind of agree with him as well, because imagine if a tapering actually comes in during the inflation where we are at 1.2%. So let's just say that the tapering helps lower the inflation by 2%, for example, and we're currently doing a year-over-year of about 5.4% from the last CPI data that we have. So if we are taking 5.4% and we are getting away 2%, we're getting back down to 3.4%, which is very, very good. But the thing is that if we taper, let's just say in 2022 or in late 2022, at that point of time, our inflation rate might be about 2%, and this tapering might actually lower it down to 0%, and then it kind of creates a deflation or a route towards the deflation, and I think that would be another troubling issue to look into as well. So yeah, I think my stance on tapering early might actually change, which is why I think I wanted to re-record this entire video as well. Of me explaining about tapering, because I was actually quite against the whole tapering way too early. I was actually very, very worried about it, especially when I talked about how I have a lot of stocks in all the industries that will be affected during this taper. But the thing is that I feel what Jerome Powell actually explained made a lot of sense for the taper to come sooner than later. So yeah, I think that actually works out very well. Thank you guys for watching. Please subscribe if you like this kind of content. Drop me a like because it really helps with the algorithm. I did sprinkle a little bit of links down there. It can give you a little bit of something, give me a little bit of something. Get $10 free Bitcoin on me with Coinbase using my link down below. I have my Moo, I have my Tiger brokers down below as well. And with that said, I hope you guys invest safe. And I'll see you guys next time. Bye!